Hey guys, hope you're doing well out there. It's time to check in with the story of Salesforce.com, ticker symbol CRM, as you have shares in free fall in the after hours, down nearly 15% after reporting their Q1 results. So we'll have to get into what has investors so concerned after reporting their Q1 results. And spoiler alert, it all comes down to their second quarter guidance coming in a bit lighter. And look, when you have a company trading up close to 28 times a forward earnings multiple, certainly you know the expectations were high for Salesforce coming in. And if perhaps this sell-off is an overreaction, we'll highlight some levels where maybe you can step in and be a buyer in shares of Salesforce. From a technical perspective, this one is breaking through a long-term uptrend and certainly decisively breaking through that. And so we'll highlight some levels where it would make sense to step in. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Salesforce up just 3% year to date, giving up a lot of those gains and more, down nearly 15.5% in the after hours. I've seen it down nearly as much as 16.5%. So for a gigantic $260 billion market cap, that is a lot of dollars flowing out of this one, likely in the early morning of tomorrow. Now, again, like we said, trading up closer to 28 times an earnings multiple. This one certainly had expectations high coming into the print, and when you don't meet those expectations, in fact come in and slightly miss those expectations, that leads to a sharp decline in your stock price. We saw this with Intuit last week, a stock similar to this, I would say, in terms of that recurring business, in terms of a software as a service. And so anytime you have these tech companies coming in with high expectations and them failing to deliver, you'll have these large volatile swings, and sometimes they can be overreactions leading to strong long-term buying opportunities. So we'll digest these numbers, really analyze it from a holistic point of view. So revenues for this most recent Q1 came in at $9.13 billion. That was good for 10.7% growth year over year. Did miss estimates by roughly $20 million, basically in line to what analysts were expecting on Wall Street. In terms of non-GAAP EPS, that came in at $2.44. Estimates were lower by roughly 7 cents. So CRM coming in with a beat on the bottom line, coming in line essentially on their revenue. Now, really where this company fell apart is on the guidance for the current quarter we're in. So before we get into all the numbers from the most recent Q1, let's first dive into their guidance for the current Q2. They're guiding for revenue to come in between $9.2 up to $9.25 billion. The consensus estimate on Wall Street was closer to $9.34, so a nearly $100 million miss on the average estimate on Wall Street. In fact, we take a look at the high-end estimate, that was closer to $9.55 billion. And so Salesforce coming in with, call it roughly $9.22 billion at the midpoint. That's a significant miss compared to what Wall Street was anticipating. Now, keep in mind, that's just for the next quarter. This company is still maintaining their full year revenue guidance to be between $37.7 up to $38 billion. Again, slightly lower than consensus, but they're looking to maintain that full year revenue guidance despite lowering their Q2 guidance. And so maybe this company just has a bit of a long-term outlook where they're seeing a lot of those customers push out their remaining performance obligations out to the next few quarters. You see, this is a company with close to $26.4 billion in remaining performance obligations, at least at the current time. That is up 10% both year over year and in a constant currency basis. And so despite this company lowering its Q2 revenue guidance by a significant margin and still maintaining their full year 2025 revenue guidance, might show me that in Q3 and Q4 this company maybe is expecting a bit of a lumpy revenue where they're expecting more of that revenue to come in later on in the year. Now, along with them lowering their Q2 revenue outlook, they're also lowering their full year fiscal 25 GAAP operating margin to now be roughly 19.9%. They're still maintaining though their non-GAAP operating margin guidance close to 32.5%. So this is a bit weird where they're lowering their GAAP operating margin guidance but remaining on their non-GAAP margin guidance. And so that's really telling me maybe they're expecting a little bit more restructuring or a little bit more stock-based compensation, something that often gets stripped out in your non-GAAP figures but is recognized as part of your GAAP figures. Maybe they're expecting a little bit more expenses on those GAAP side, likely due to either stock-based comp or restructuring that will affect those margins on the GAAP basis. So that's something to consider. This company is seeing a bit more GAAP expenses coming down in the year. And then lastly, despite lowering their Q2 revenue outlook, they're maintaining their full year operating cash flow growth guidance somewhere between 21% up to 24%. So from a high level overview from the most recent Q1, that came basically in line, a slight miss on the revenues and a slight beat on the earnings, basically coming in line. It's the Q2 revenue outlook that has investors spooked, that have investors selling off this stock by nearly 15.5%. But something, if you are long Salesforce and you still believe in this company for the long term, your bull case that you're making is this company maintaining its full year 2025 revenue guidance and not lowering that. Certainly, if they were to lower this full year guidance, that would be far, far more concerning, where they don't really see a pickback in those revenues in Q3 and then Q4. In terms of the EPS for the full year, again, this is a company that's still expecting rapid growth on their earnings side. So for the upcoming quarter, they're expecting 234 up to 236 in terms of bottom line EPS. Estimates are closer to 240. So even for the upcoming quarter, coming in slightly underneath expectations for the most recent quarter. Keep in mind though, for the full year, company expecting to do 986 up to 994 in EPS. That is still slightly ahead of what Wall Street is estimating. Their numbers are closer to 980. So despite lowering Q2 revenue and coming in slightly underneath on those Q2 earnings as well, this company is still expected to maintain full year revenues and then expected to exceed full year EPS expectations. So this company really has a longer term story, and part of me believes that the remaining performance obligations, at least some of them, will get moved to the back half of this year. Now, despite that, coming into this print with a nearly 28 times earnings multiple and trading close to 7 times on a sales basis, certainly still is expensive. And so you have those high expectations, and even despite that this fears are really only expected to last a quarter, that's still not something investors would like to see, selling off the shares by close to 16%. Now, like we said, close to 7 times on a sales basis. That's on a forward sales basis. So on a trailing one, still closer to 7.5 times sales. And historically, as this company comes up close to 7, even 8 times sales and then higher, that's where you look to take your profits. Really where this company doesn't become a great deal, I would say still an okay deal, but not one of those screaming buys. Anytime this company trades underneath a 6 times sales, that's where it becomes far more attractive. Really, it has only happened a couple of times over the past 10 years with CRM. And so really you want to pick this one up underneath a 6 times sales. And now with a 15% sell-off in the after hours, certainly that is looking more plausible, as you're probably trading closer, I'd say closer to a 6.5, even 7 times sales on a forward basis. So certainly not as egregious as it has been in the past, but keep in mind, this is a company now expecting full year revenue growth to come in between 8 to 9%. So on just 8 to 9% revenue growth, you simply can't put a large sales multiple. I think closer to 6 times really would make a lot of sense for an 8 to 9% grower on that top line. Now, despite that, this is still a company with some terrific margins, at least on those growth side. Now, they don't have great operating margins just yet, but they are on their way there and making some strides in that direction. So we have $9.1 billion in total revenues. Again, like we said, that was good for 10.7% growth year over year. Last year, we were closer to a figure closer to $8.2 billion. Now, like we said, from a gross profit perspective, this company chugging right along. You have nearly $6.9 billion generated in gross profit, as this company really was able to control the cost of those revenues, as those only ticked up, call it $40 million, despite raising your revenues by nearly $900 million. And so from a cost of revenues perspective, looking very controlled, allowing them to raise their gross profit by close to $800 million. Last year, you were closer to a figure $6.1 billion on that gross profit side. Now, where this company really eats into those gross profits is on the operating expenses. And so you see this company having a fair amount of R&D expense, nearly $1.4 billion, up from 1.2 same quarter last year. Along with that, sales and marketing, a big portion of CRM. Certainly they're a Salesforce company spending a ton on sales and marketing, as you have close to $3.2 billion. Last year, you were at 3.15. Along with that, G&A ticking up just a little bit, and then this company not really seeing a lot of that restructuring expense come in this most recent quarter. A lot of that restructuring happened in 2023, and so last year in the same quarter, recognizing roughly $700 million expense in terms of restructuring. And so when you look at the operating income just on face value, looks phenomenal as you go up from 400 million up to $1.7 billion in operating income. But keep in mind that restructuring expense, not something that will reoccur, and one of those one-time expenses that likely, in my opinion, should be added back to their last year's income from operations. So really on a year-over-year organic basis, this company growing income from operations, call it roughly from 1.1 up to $1.7 billion. So still phenomenal growth on your income from operations. You added close to 900 million on your revenues, and you bolt on roughly 600 million to to your income from operations. And a lot of that flows down to your net income. So again, if you add back that restructuring charge, your net income last year was closer to 800 million. Now it's sitting closer to 1.5 billion. So terrific growth on the earnings side. This is one of those companies in the past that really have had strong revenue growth, but really not been able to translate those into net income dollars. Now they're finally turning the page into large amounts of profitability, really flowing through a lot of net income. And when we get down to their cash flows, a lot of that flows down to their cash flows. Now, this is a company that is doing a little bit of a buyback, and so you see diluted shares outstanding coming down just a little bit, not a whole lot year over year, but keep in mind, this is a company that does a fair amount of stock-based compensation, and so a lot of that buyback, all it's doing is canceling out your stock-based compensation, the dilution you get from that. You're basically just mitigating that. So year over year, you're not really increasing your share count, not really decreasing it, but you do have a buyback in place. From a balance sheet perspective, all things looking good. This company is sitting on roughly $10 billion in cash and equivalents. This is on a quarter over quarter picture, so not really different from 3 months ago. This company did move through a fair amount of those receivables, and so that allowed them to bolster on a little bit more cash by a little bit more into marketable securities. So all things considered, $25.5 billion in total current assets, balanced out by roughly 23 billion in current liabilities. Keep in mind, nearly 16 billion of that, although, is in unearned revenue, and so not really a liability. This is just a service they might have provided, but still waiting on the revenue for that to come in. And so really only I would consider this a liability if you expect their customers to really be unable to make their payments to CRM, but likely not a case I would consider. And so from a current ratio, looking all good. And then from a debt perspective, roughly 8.5 billion in long-term debt, another 1 billion in short-term debt. So this company has more cash on hand than all debt combined. And so that's certainly a good thing to see from a balance sheet, nothing to really worry about. Again, we pulled down a $1.5 billion net income figure, substantially higher than same time last year. Keep in mind, you had that restructuring expense in the same quarter last year. But really, the bull case with this company lies in their cash flows, and that's really what Mark Benioff and the management team over at Salesforce often talk about, is how well this company is now growing their adjusted operating cash flow and then their free cash flow. So we see operating cash flows coming in at $6.2 billion for the most recent 3 months. That is spectacular. That was up 43% year over year. That is phenomenal growth on your operating cash flows. And then this company, not very capital intensive, just $160 million in CapEx. And so you're looking at free cash flow of close to $6.1 billion. So this is now a company that's doing roughly $2 billion, in fact, more than $2 billion run rate of free cash flow per month. That is certainly impressive, a long way from where they were basically a year ago, even 2 years ago. Salesforce certainly moving in the right direction. And so with that, more than $6 billion in free cash flow, they pick up more than half of that goes to marketable securities. A little bit goes into acquisitions. This is one of those companies that isn't shy from doing acquisitions. They've done that acquisition of Tableau, MuleSoft, Slack. Now likely regulatory scrutiny will pick up for Salesforce if they look to do any meaningful acquisition. So likely this $300 million acquisition, probably a smaller tuck-in acquisition over at Salesforce. And the rest of that they use towards the buyback, close to $2.1 billion, slightly higher than same time last year. But again, keep in mind, this is essentially just mitigating the dilution you get from stock-based compensation. And then for the first time ever, this company paid out a quarterly dividend close to 388, roughly rounded to $400 million. Now, from a forward yield, you're looking at just 0.15%, and on a per share basis, that's close to 40 cents. So certainly not impressive, at least at the current time. But keep in mind, this is a company that's guiding for full year EPS to come in close to $9, in fact, close to $10, and they're posting just 40 cents per share in terms of that dividend for the full year. So this is a company that has a long runway of dividend growth ahead of it, and maybe not at the current time, the dividend might not look impressive, but if you have a long-term outlook with this one, holding it over 5 and 10 years, your cost to dividend yield will certainly become quite impressive and allow you to generate those consistent quarterly returns. So from the financials, all things looking good, at least from the most recent quarter. We'll have to see what their Q2 really looks like. The revenue guidance coming in a bit light, but really that's the only concerning thing that I can find with this print so far. Everything looking in line. They're continuing to grow free cash flow. They're continuing to grow earnings, and just margins coming in slightly lower, at least on that gap side. and revenue for the upcoming quarter coming in lighter, but in my opinion, nothing to warrant a massive 15% sell-off. So part of me is thinking that this could be considered a overreaction by the market, and certainly overreactions in high quality names is something we as long-term investors absolutely love to see. Now this one is coming down to a level of support which once acted as a level of resistance back in July of last year, coming down to $229. Now, in my opinion, this is a company that can look to be range bound for the next little while. Certainly, this is a steep decline. So at the current time, while this could be considered a level where the stock could see a reversal just from a support trend line, this is a falling knife, as I would call it, and it would be tough to catch it at these levels and expect to see this one certainly react positively in any meaningful way. I think this one will continue to trade lower over the next few days. I would wait for it to settle out and sort of trade sideways. While I do think this is an overreaction to the lowered Q2 revenue guide, I think this one trading down a little bit more over the next couple of days is something that we can absolutely see. And so what I would expect is this one to come in at least in the middle end of this channel underneath $220 a share, and that is really where you accumulate between these red lines, somewhere between $200 up to $230. That is your point of accumulation with a stock like Salesforce. Really, that's where it has been trading over the past 1 year before this massive rally higher, and I fully expect this one to come in and once again trade sideways within this channel, at least for the next little while. This is really where I would get excited in picking up shares of Salesforce, one of those companies that can absolutely see myself opening a position for this one, considering they're just spitting out large amounts of free cash flow now, doing a little bit of a buyback just to mitigate their share-based compensation, and then you do get that dividend that you can expect to grow over time. And this one is one of those underrated, I'd say that second or third tier AI plays that really isn't incorporating AI directly, but is still benefiting from AI in a large way by getting more data on their customers, making their products more sticky, and also driving efficiencies within their own business. So certainly a second or third tier AI play that has a absolutely dominant position in the market in terms of customer relationship management software. That was my take on shares of Salesforce. Let me know what your thoughts are on this one in the comment section below. Are you coming in here and picking up shares on this nearly 16% decline in the after hours? Certainly I would wait for this one to sort of settle out, trade sideways before making my moves somewhere in the $200 up to $230 price range. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.